Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's episode of Recon Reports, the mission is a full debrief of a trade on Duolingo. So gear up and let's go to work. First, let's start with sitrep. On the chart, we can see Duolingo had been hit pretty hard. It experienced heavy losses, roughly a 70% drawdown from its peak, and was trading below both the 22 and 150-day moving averages, which is classic damage territory. That is usually not where you go hunting for long trades. For this trade though, the objective was different. I was intentionally scouting stocks that were beaten up and trading below their short and long-term moving averages. Game plan was to assess the potential for a short counter-trend move. Duolingo caught my interest because of a huge gap down and elevated volatility associated with the ticker. My working assumption was that the downtrend might pause, form a support area and reverse upward. At that point I decided I would use MACD cross as a basic sign of a potential shift. That would also serve as my signal to enter the trade. My target acquisition marked this as a C-grade counter-trend setup, so the rules were clear. Small initial size, ATR-based stop, and a tighter leash than on a strong conviction A-grade trade. Let's now walk through the trade and see how it played out. My initial entry point was at 177 and I bought one share. For my account size and risk rules, that is a probe, not a full position. The setup looked weak, so I did not want to commit much capital until the market proved the idea. After the order was filled, I placed a stop order around 1.5 ATR beneath the entry, using volatility to define the risk zone instead of some random fixed dollar amount. That kept the maximum loss on well within my position protocol while still giving the trade enough air to move. Initially, the price action went against me, which is common in counter-trade setups, but then it reversed and made a relatively strong swing to the upside. The idea started to work, and that is where the trade management story begins. When the price moved up, I decided to increase my position and bought another share at 191. To stay in line with my overall risk rules, I also adjusted the stop order upward so the combined position still respected my maximum per trade risk. At this point, however, I broke one part of my rules of engagement. Those are my trading rules. Normally, adds should come in fractions of the initial position, 1/4 or 1/3, and there is a predefined cap on total size. In this case, I effectively doubled the size of my initial position in one step. I allowed the fact that the trade was profitable and the size was still small, in absolute terms, to justify loading up more than my usual scaling plan. It did not stop there, which I consider the first mistake in this trade. I added again at 205, this time half a share. My total position was now 2.5 shares at an average price of around 188, with the trade still profitable by roughly 8 to 10%. That is not a disaster in terms of risk, but is a clear deviation from the rule of incremental pre-planned adds. At this stage, price had moved into the 22-day moving average, a level where often something tends to happen. Either the downtrend resumes or momentum shifts enough to reclaim the line. For this mission, that moving average should have been my decision line. I opted to wait it out and see which direction the price would go. If it broke cleanly above the 22-day moving average and held there, that would have been a green light to continue managing a winner. But it didn't, and that is where I made my second mistake. As soon as it became clear that the moving average was not being reclaimed, price moved around it and stalled instead of breaking and holding above. My playbook should have been simple. Take profit on at least part of the position, tighten the stop aggressively, or close the trade entirely and bank the gain. Instead, I waited for extra confirmation for several more trading days. Eventually, I submitted a sell limit order at 187 for one share, taking some risk off but not treating that failure at the 22-day line as the hard exit signal it should have been. Because Duolingo is volatile and the dollar amount of risk was small relative to my account, I chose to keep the remaining position at wait. Over the following days, the trade drifted sideways and not in my favor, and I finally submitted a limit sell order to close the rest of the position. The trade went from meaningfully profitable to roughly flat, not because the idea was terrible, but because the execution of profit taking was weak. To summarize the trade in numbers, total capital employed around $471 or about 9% of the total account value. Maximum risk on the trade, $26 or roughly 0.6% of the account value. Final result, a loss of about $1.67, around 0.3% of the capital deployed. Holding period, 25 days for the first reduction, plus an additional 6 days to fully close the position. From a risk perspective, this is actually a successful mission. The trade stayed well within my risk limits, position sizing was small relative to both account and volatility, and the final loss was negligible. From an execution perspective, however, the mission underperformed. A trade that spent a meaningful amount of time in profit ended near break-even because I did not act decisively. Biggest lesson from this trade is to be more disciplined in profit taking, particularly in counter-trend trades. Here are the key takeaways from this Duolingo mission. The initial setup was C-grade, counter-trend, so starting with a small probe and an ATR-based stop was correct. Weak setups deserve small size and tighter leash. I broke my own rules of engagement by doubling and then adding again instead of using smaller pre-planned scale-ins and respecting a maximum size cap. Profit does not justify breaking rules. The 22-day moving average was the decision line. Once price stalled there and failed to reclaim it within a few sessions, the correct action was to take profit or exit, not to wait for more confirmation. The trade was in profit for a relatively long period but finished close to flat. The main failure here was poor profit taking, not risk control. Execution on taking money off the table must improve, especially in counter-trend trades into key moving averages. A field note from this mission. When a counter-trend gives you a fast 8 to 10% pop into a major moving average, your job is to get paid, not to get greedy. And with that, we conclude this episode of Recon Reports. If you found value in this mission, lock in your support by liking, subscribing, and following our movement. Be sure to join the next episode where we will discuss different order types. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.